All right, let's talk nCino. They just dropped their Q3 earnings, and wow, after what's been a really brutal year for the stock, these numbers, they're screaming that a turnaround might actually be here. So we're going to dive right in, break down the key results, figure out what's behind them, and what this all means for the stock. Okay, first things first. The headline number everyone is buzzing about, 31 cents. That's the non-GAAP earnings per share. This is the big one, the key profitability metric that all the analysts had their eyes on. And listen, this wasn't just some tiny little beat. No way. They absolutely demolished the Wall Street consensus, which was sitting at around 20 cents. We're talking a nearly 55% surprise. A beat this big, that's the kind of thing that can completely change the narrative for a company. So you can guess what happened next, right? The market reacted instantly. The stock shot up over 6% after hours. That's a huge vote of confidence from investors. It really begs the question, what was in this report that got everyone so excited? Well, when you dig in, it really boils down to two things: fantastic execution on the top line and an even more impressive story on the profit margins. So let's kick things off with revenue. So on the revenue side, they pulled in over $152 million. That's a solid 10% growth year over year. And importantly, it's a clean beat against that consensus number of about $148 million. So check one, a solid beat. But it's not just about the number itself. What's absolutely crucial here is the quality of that revenue. A whopping 88% of it is from subscriptions. For anyone investing in software, that's the holy grail. It's recurring, it's high margin, it's predictable. It tells you the core business is just humming along. Okay, but this right here is the showstopper. Look at that swing in GAAP operating margin. They went from negative 0.6% a year ago to a positive 8% today. That's an insane 800 basis point expansion. It's massive. And it's undeniable proof that their focus on cost control is paying off in a huge way. This is a company that's clearly shifting gears from growth at all costs to smart, profitable growth. It's a huge deal. And this wasn't just them getting lucky in one area. Nope, the momentum was everywhere. They expanded deals with 2 of the top 50 U.S. banks, landed a big new mortgage client in Japan, got a top home builders lending arm on board, and even renewed a deal with a huge Czech bank at a higher value. So yeah, the growth is coming from all corners of the globe. Okay, so a fantastic quarter. That's great. But we all know what really drives a stock price is what's coming next, the outlook. So let's shift gears to their guidance because this is where that AI theme really starts to heat up. And there it is, the textbook beat and raise. It's one thing to have a good quarter, but to then turn around and raise your forecast for the rest of the year, that's management basically shouting from the rooftops that they are confident. They bumped up both revenue and, even more importantly, that earnings per share number. And this quote from the CEO on the earnings call, it just says it all. The conversation has completely shifted. It's not, what is AI anymore? Now their customers are asking, how fast can I get it? This is huge. It means AI is officially moving from a cool buzzword to a real, tangible thing that's driving sales. So what's the game plan? Well, it's pretty clear. 1, push their AI tools hard. 2, get customers on this new pricing plan that's already giving them a 10% lift. 3, expand internationally. And 4, make the most of that DocFox acquisition. It's a solid strategy. And get this, management sounds pretty confident they're on track to hit the Rule of 40 by the end of next year. For a software company, that is a huge milestone. Okay, so the results are great. The outlook is strong, which leads to the million-dollar question: why has this stock been such a dog? And you know what? That disconnect is exactly where the opportunity could be. You really have to rewind to April to get the full picture. The company gave some weak guidance, and the stock got completely hammered. Down more than 30% in one day. Ouch. Since then, it's been this slow, painful climb to win back trust. But this quarter? This feels different. This feels like the moment that repair phase is finally in the rearview mirror. And look at this chart. It just lays the disconnect bare. The software index is up almost 30%. The S&P 500 is up nearly 15%. And nCino? It's down almost 40%. The fundamentals are clearly getting better, but the stock's valuation is still stuck in the penalty box. That's a massive gap. So, that's the big question on every investor's mind now, isn't it? With the company executing this well, is it finally time for the stock to get a re-rating and start closing that gap with its peers? All right, let's wrap this all up. We've seen the numbers, we've seen the story.
Now it's time to make the call. Where do we think nCino goes from here?
So we're going to assign an equity research style rating. When we say outperform, we're just saying we expect the stock to do better than the rest of the market over the next year or so.
And for nCino, our rating is outperform. The thesis is pretty simple, really. The turnaround isn't a maybe anymore. It's real. AI is starting to fire on all cylinders as a growth driver. And that valuation gap we just looked at, it's just too big to ignore. It's time for a re-rating, where investors start valuing this company more appropriately.
So how would we pitch this as a trade idea? Let's frame it up.
Here's the pitch. We're going long nCino. The market absolutely punished this name for the better part of a year, but the repair phase is over. This beat and raise quarter, supercharged by AI traction and incredible margin expansion, is the catalyst. This is the inflection point. The story is no longer about fixing what's broken. It's about a multiple expansion that sends the stock right back toward its peers.
And of course, we have to say it, this is our take on the quarter. It is not financial advice.